Excel file.
Excel file.
No, no. Yeah. Right. Good morning to you all. Those who are in online, can you hear? Can you see? Right? Are you okay? Today online, nobody is here because of that, the bus strike. Right. So therefore, those who are in online, so I want your active participation because we have some of the exercises to do today, right? So, right? Okay. Okay, thanks. Right. If you can remember that we discussed in the last week on planning of your audit work, right? So, and again we discussed the materiality. So, very important area, we discuss about the materiality. So, just to recall what we have discussed, because that is linked to the things what we are discussing today, right? So, if you have any comments, you can type or you can ask. So, please make your the continuous attention and the participation for this because as I mentioned, nobody is here. So your support is very much important as the online that participation, right? Right. If you can remember, so we discussed the materiality. Finally, we discussed the materiality. So what's all about materiality? Right? What's all about materiality? Yes, any idea? Right. So it is something significant for the users. So in simple terms, that's the idea, right? It is something significant to the users. So how does it become significant? It becomes significant so that information is that make a sense or make a change to the users. So then that information will become as material information, right? So that's the basic understanding. Then we discuss again, it's judgmental, right? So to calculate the material, you should have the professional judgment, right? So I have given some basis or the criteria, but it's not a hard and fast rule to take those that criteria to calculate the material. It's only a guidance. It's only a guidance to calculate the materiality. But again, finally, what is most important is the professional skepticism or the professional judgment made by the auditor, right, in determining the materiality. And again, I discussed materiality can be changed based on the risk assessment. So based on the risk assessment, that can be changed, right? So already those things we have discussed. Then if the risk is going up, so once we assess the risk is going up. So because they don't have such internal controls, they don't have such the good mechanisms in case of financial transactions or the controlled environment. So then what we have to do? So our risk also going up. Then what can we do? We have to reduce our materiality and to increase our sample size and to extend our audit procedures, right? So basically, I just talk about the overall picture of the organization or the materiality calculation. But again, there are two more, the materiality calculations. One is, the overall materiality or to the financial statements. The other is performance materiality, right? Performance materiality means something lesser than the overall materiality. Why is it? Because it is for the whole organization. But when it comes to the one account balance, that then we should take some sort of lesser material level to increase the sample size. So therefore, even in the practice, the firms are using the performance materiality for the sample size calculation, right? So even the overall material if you can take, but still, so then what can happen is your sample size will be reduced. So if you want to extend your audit procedures, it's up to you to decide. You can go with the performance materiality which is lower than the overall materiality of the financial statements, right? Again, one more, the calculation is there. That is for the, as we discussed, if you can remember, right? That is for the uncorrected misstatements, right? Uncorrected misstatements. So you can compare misstatements together, right? Aggregate misstatements with the, the materiality you supposed to calculate. So it may be different from the overall materiality as well as performance materiality. So with those it can be different when we compare uncorrected mistakes together. So with the materiality you supposed to calculate. It's all about the professional judgment, right? So because of the misstatement, so why those people, or why does the manager don't make the corrections for those things? It's a impairment integrity. It's the impairment of the integrity. So that's a, that beyond the figures, that is very much important. So why do they, supposed to do, or why do they impair the integrity of the management? So then we have a reasonable doubt on the management on the other works as well. So that's why it should be even lesser than the, the performance materiality. So it's up to the, the professional judgment again, right? So that those are the overall concepts that we're supposed to discuss in materiality. That is very much important, because as we discussed, material depends on everything. So whole depends on materiality, right? That may be the overall materiality or the performance materiality or the other materiality we're supposed to calculate when we are comparing uncorrected misstatements together, right? Any comments? Can you hear? You understand what I am talking? Any comments? So this is, today's session is very much, difficult to handle. I am lecturing for the computers, nobody is here. So please support me to continue the lecture. So if you have any clarifications, you can talk, you can feel free to talk, you can type, no issue. So whatever the, clarifications you can make. So far any comments? You understand what is materiality and what is the importance of materiality? How to use the materiality in our, the audit process? Please make your comments on that. Yes? Right. What about the others? One student pointed that okay. So what about the others, those who are in online? Any comments? Okay. Right. So with that we move on to today's discussion. Right. So this is again, as we discussed, so this is again important, and again this is linked with what we are talking today. So that is analytical procedures as well, right? So as we discussed, the audit is a what? So assurance engagement, and again that is, our approach is the risk-based approach, right? So we have to do that, we have to accept that. So the audit approach is risk-based approach. What does it mean? We have already discussed those things. Just to recall, what do you mean by risk-based approach? So very simply, we are not going for 100%, that check-in of or vouching or verification of account balances, or even check-in of audit evidences, right? So instead, that 100% check-in or the overall check-in, 100% check-in, what we supposed to do? we get the representative sample and collect the audit evidences on that and make our opinion on those account balances. So that is what is happening. So in a general audit, it means that there is a risk when we are making our opinion. Why? Sometimes the not approach the material misstatements in the financial statements. Sometimes that can happen. So there is no such guarantee. Our sample is enough. Our sample is appropriate. Right? We don't know how the misstatement comes in. That may be because of that error or fraud. Right? So as we discussed, if it is because of the fraud, again very important to detect, very difficult to detect. Right? Because the fraudster is trying to hide that, conceal that. Right? That is the issue. That based audit approach. So by saying so, we can't check that 100%. It is impracticable, right? So therefore we have a basis, and we should have that guideline or the framework to do. So in that case, planning is very much important. Planning is very much important, right? And again, most important point, so with the risk-based audit approach, you have to assess the risk of the client. You have to assess the risk of the client. As we discussed very correctly, if the risk is, once you assess the risk, if the risk of this client is higher, you have to reduce your material level. If the risk is in the average level, you can proceed with the planned originally. Right? If the risk is lower, it means that company is going well. I mean, no internal control issues, the control system is very good, right? So they are complying with that. So then again, you can calculate or evaluate the risk of that particular client and make your audit strategies. Make sure that no over, right? So for you have to assess the risk in your planning stage. Right? Right. So the other important point is, already we discussed, what is audit risk? What is audit risk? Those who are, please type your what is audit risk? Please type your answer. What is audit risk? Right? I want you active, that participation. Please write. Please type. Right? What is audit risk? What is audit risk? Simple answer. Yes? Nobody? Right, audit risk is what? For inappropriate audit opinion when the financial statements are materially misstated. Forming an inappropriate audit opinion when the financial statements are materially misstated. What does it mean? Financial statements contain material statements, but still as the auditors we are not in a position to detect that. Therefore, we form the opinion statements give true and fair view. That is the issue. That is the risk. It means that we are forming an inappropriate audit opinion. Then, addressing what we are, reporting. But it is something wrong. It is fundamentally wrong sometimes because report. But it is incorrect. In real case, it is incorrect. That is the risk of the auditor. Right? So, you have to assess the risk. Why? as we discussed, we want to assess the risk to reduce to an acceptably low level. We cannot eliminate the risk. We have to manage the risk, right? We have to manage the risk. So therefore, we have to assess the risk. In that, what is more, so you should understand the entity and its environment, right? And assessing the risk of material misstatements. So basically, you should understand the overall business entity. How does it operate? So where the where does the entity operates? It means the industry. So what are the industry norms? What are the company specific issues or that the practices, industry practices? So you should have those overall about the business, right? About the business to get an very good understanding and make your risk assessment. Very important. Very important. Right? Right? So in that case, you should understand the entity. So as I pointed out, right? So and assess the risk. So in that sense, so we'll discuss later on what are the risk components of the the risk. What are the risk components for the auditor and all those things, and how do you address for those aspects. So in that case, what I want to tell you is, analytical procedures in the planning stage is a very, very important and essential tool for what? To assess the risk. Why? Why? So in practically what happened is, in the planning stage, you have a set of financial statements prepared by the management. But in those informations, right, and having these, the and its environment, right? So when it comes to the environment, it talks about so what are the legal implications, right? So who are the competitors, what are the industries, everything, right? You should understand everything. Tax implications, right? So understanding everything, and again, company specific information. So you should do a very good analytical procedures in the planning stage. It means using the client's financial statements. By doing so, you will be able to understand what are the more risk areas of this particular company, what are the most significant or the core particular business, right? What are the core areas of that particular business? Where, right? It's a part of risk assessment. What are, gross profit has increased by 10% from last year to this year. Is it acceptable? But when it comes to net profit, 5% decrease, right? So all be considered, all those matters to be considered in the planning stage as the risk assessment tool. What to address, right, when it comes to that our performance of the audit work. So if you don't, so then you understand, you want to focus more, so then nothing to do, because you have to complete your audit work. So they are understand more risk areas where at the initial stage or the planning stage of the audit. It's very important, right? That's why you want to do the risk assessment in advance, and to make sure that you should focus. These are investigation or checking on your financial account balances and collect some of the account audit evidences. That's enough for those areas. But in these areas, right? And inconsistencies. What are deviations from the industry? What are deviations from the competitors? Everything you should understand. What to, or you should have the comparison in all to have to make sure that this company is deviating from these areas. These are consistent. So if these are deviating, you have to collect more audit evidences. It means that make sure that the company account balances are correct, appropriate, their disclosures are enough. At least the minimum requirements are enough to make the decisions by the investors or the shareholders or the stakeholders. Right? And make sure the reliability of those informations. So therefore you should do the risk assessment at the planning stage. So to that plan your audit work in a proper way. It means to reduce your risk to an acceptably low level, right? So that is the main requirement of risk assessment and the importance of risk assessment for our work. So very good tool to assess the risk is the analytical procedures. So after this we will discuss the analytical procedures. If you have any comments, you can ask. Yes? Sound is not clear? Right. I will upload that presentation to the LMS. It's all right. Sound is not clear now. Is it okay? I will upload the presentation to the LMS. So one presentation I just missed, this one. Others I have already uploaded. I will upload that one. Right? Now sound is okay. Any comments? It breaks sometime. Right, we'll see. Right, okay, thanks. Right. Sorry. With this understanding, we move on risk assessment part in the PowerPoints. So that is what we discussed basically. Right. So this is something about the risk-based auditing. Yes. So I think you have discussed that the business risk. So I'm not going to discuss that much of on business risk. Actually, what is the business risk? Huh? Actually, basically, it's the difference between what we have already set and what we have already achieved. In simple terms, but really what you are getting. The difference is what? Business risk. So that's what mentioned here. So you can have a lot of definitions on that, but in simple terms, that's the idea. So then what can happen is, so let's say you have set to have that the vision, mission and objectives, goals and everything, but really you are deviating on that, right? You are really deviating on that when it comes to the actual performance. If it is the case, now what you are planning, or that what the management is planning to manipulate whatever the informations to take into the real or the expected level or the anticipated level. There is a pressure on that to make the figure or that information to the expected level. There is a pressure. It doesn't mean that every time those things are happening, but there is a probability of happening those things if you have such a targets and the goals, objectives and everything, right? Other you will be challenging. I mean that shareholders are asking, so what? So then you should be answerable as the management, not as the auditors, right? So then what the management is doing, so they are planning to manipulate the financial statements to satisfy the other stakeholders. Otherwise, they will be the failures. They don't get their the required as the bonuses or salary increments or whatever it is, right? So therefore there is a probability of manipulating the financial statements So if the business risk is getting higher, right? So that is what is mentioned here. Risk results significant conditions, events, circumstances, actions or inactions that could adversely affect the entity's ability to achieve its objective, execute its strategies, or from the setting of inappropriate objectives and strategies. Right? Okay. Now it's okay, right? You can hear, right? Okay. So this is something about sources of businesses. It's a change, yes. Definitely a risk. Complexities, yes. So a lot of complexities can arise, with the change. So always, things are getting changed. So then you should be cope with that. So otherwise, you will be somewhere else. So then again the complexities arising, technical complexities and other complexities. So all leads to the risk, a failure to recognize a need to change. Right, now we are straightly come back to our discussion. So what is audit risk? Already we discussed. The risk that the auditor express an inappropriate audit opinion when the financial statements are materially misstated. Already we discussed, I am not going to repeat the same. Audit risk is a function of the risk of material misstatement of the financial statements, and detection risk, the risk that the auditor will not detect such misstatements. Right? So first one is the probability of having the material misstatements in the financial statements. Right? The other one is still the risk. Material statements are in the financial statements. If you are so then you can eliminate that risk. But still the financial statements are having those misstatements, but again the auditor is not in a position to detect those misstatements. That is detection risk. Right? Risk of those material misstatements, that is so called detection risk. Yes? Right. This is the overall, the classification on that. Audit risk classified into audit risk of material misstatement and the detection risk. And risk of material misstatements comes in two ways: inherent risk and the control risk. Right? Basically, therefore, you have three components of risk for the auditor: inherent risk, control risk, and the detection risk. Right? I am repeating: inherent risk, control risk, and the detection risk. So we'll take one by one. What is inherent risk? What is control risk? What is detection risk? So right? What is inherent risk? Inherent risk is that there is no mandatory requirement in local context, in Sri Lankan context, to have the internal controls in a business. It depends on the management requirements. Right? It's up to the management to decide to what extent we want to have the internal controls. Right? Because, and again, that is important for the auditor. If the management is not having the internal controls, what can happen? If the management does not have the internal controls, what can happen? Right? So auditor is getting higher or not? Getting higher or not? It's getting higher, definitely. This is the but test of control. Test of controls. Already we discussed. Right? This is the is there. No controls in the business. Right? This is the highest risk that is in. You have test of controls, you assume, you understand that no put in place. Right? Well, then what you have to do? You have to reduce your material level and you have to extend more. You have to do more and more audit procedures and collect more and more audit evidences to make sure that, or to make your correct opinion on the financial statements. Right? Once you accept the engagement, you cannot reject at the middle or in the middle. But because of that, so we can't extend our, we can't form our opinion. So you can't tell like that. So they have to do is we have to do more and more audit procedures and collect audit evidences and reduce the auditor's risk to an acceptably low level. So that should be done in the planning stage. So and make sure that no controls in the business, and then in the planning stage then assess that risk is getting very much higher. Right? That is inherent risk. Then the second aspect is what? Control risk. A risk that a mistake and that could be material will not be prevented on a timely basis by the entity's internal control. Now they have a control system, but that internal control system is not that much sound, sophisticated. For what? To prevent on a timely basis. They have them now somewhat okay, but decision to detection of those material misstatements in the financial statements. Right? You some level, right? But you have a risk compared to letter in this scenario. But again you have a risk. So there again you have to select your sample or material level and make your sample selection. The third one. Right? Detection risk. This is not from the client. This is from those. These two comes from the management or those from the management perspective. These are control environment, right? Internal control system. But detection from the auditor side. The audit procedure not detect the material misstatements in the financial statements. It's so the other that final impact will come to us. But here, something wrong with us. The risk that in an assertion that material individually or when aggregated with other misstatements. Right? Very simply, our audit procedures are not facilitated to detect that type of material misstatements. Right? It depends on the effectiveness of our audit procedures we are performing. Right? Right. So risk assessment of, here what is pointed here, the assessment of risk of material misstatements may be expressed in quantitative terms such as in percentages or in non-quantitative terms. You can quantify that. sometimes it's very difficult to quantify, right? So everything you have to incorporate, everything you have to understand. So in any cases, the need for the auditors to make appropriate risk assessment is more important than the different approaches by which they may be made. So finally, what is the most important point is, in the planning stage, you want to make the risk assessment, right? You want to make the risk assessment about the client, because your overall, the work, so what you are supposed to do will depend on the risk of the client. So the impact or the final answer for the risk assessment in your risk assessment procedures, right? Already we discussed, I don't want to repeat the same, right? So then, as we discussed, risk is classified into three, right? So inherent risk, control risk, and the detection risk. All three we have already discussed. So as a result of that, audit risk is equal inherent risk into control risk into detection risk. This is the multiplication for the audit risk. Then how do you reduce the audit risk? You should have the adequate planning, proper assignment of personnel to the engagement team, the application of professional skepticism, and supervision review of the audit work performed. Very important. To reduce the risk mitigation, risk management strategies. So once you calculate the business risk for your whole organization, you should have risk mitigating factors or risk mitigating strategies. So for the auditor, risk mitigating strategies are like this. Proper planning, yes, it's a must. It includes the materiality and everything. Then proper assignment of personnel to the engagement team. You should have the proper people. It means the auditors. So in the senior people, those who are having the technical knowledge and know-how, and juniors, everything, right? Partners, that audit managers. So different levels you should have, and make sure that you should do the proper supervision and review of the audit work performed. And the very important point again, the application of professional skepticism. The professional skepticism. Right. This is again, talk about the detection risk. So what is pointed here is not that much of important. The greater the expected risk of material misstatements, it means what? If the inherent risk and the control risk is higher, the less the detection risk and vice versa. It means, if you have large number of material misstatements, you will be able to detect that. So that is in the other way around, right? Vice versa. So that is pointed here. As we discussed, an understanding of business risk increase the likelihood of identifying risk of material misstatements for the purpose of the audit. So if the business risk is higher, it means the auditor's risk also getting higher, because there is a pressure from the management side to manipulate the financial statements. So therefore we should understand what's the business risk that the company is facing. That's what here pointed out. Most business risk will eventually have financial consequences, and therefore an effect on the financial statements. So that's what we discussed, right? So what is auditor's requirement? So how do you plan in and how do you make the assessment? The auditor should obtain an understanding of the entity and its environment, including its internal control, to identify and assess the risk of material misstatements of the financial statements, whether due to fraud or error, and sufficient to design and perform further audit procedures. So this is the most important paragraph. This is the most important thing what we have discussed. This is the conclusion of our discussion, what we have done so far. right? So what is pointed here, I will take one by one. So everything we discuss, but again I will point out, I will be taking from here. The auditor should obtain an understanding of the entity and its environment. Yes, what include controls. So it means company and the internal controls plus understanding the environment. So as we discussed, what are for this particular company, that is legal environment, tax environment again includes that part as well, and competitors and everything, right? So you should understand that including internal controls, as the statements of the financial statements, whether due to fraud or error. You know that misstatements can arise from either from fraud or error, and perform procedures sufficient to design further audit procedures, right? So it depends on your risk assessment. So to what extent you want to extend our audit procedures. So that is the requirement for the auditor as far as concerned the assessing the risk of the client. So you can ask any comments, any clarifications. This is not a one-way transaction. So your comments are very much important. Right. What we can perform, this is the practical perspective on that. So an overview of the requirement of SLS 315. You can assess the risk, making the inquiry from the management and the inspection procedures. This is very important. OLA is very important, and team discussions. So these are the part of risk assessment procedures. Then again, to understand entity and its environment, you can do the PESTO, PESTEL or whatever it is. What is PESTEL? You are studying the strategic management, right? Then in the entity and accounting and internal control systems. So then you understand the internal control system and the business, right? So and understand the entity and its environment. By doing so, you will be process of understand the entity and its environment, relate the risk to assertion level, identify significant risk. Basically, this is understand the entity and its environment and assessing the risk of material misstatements. Right? That risk assessment can be done through these inquiries, observations, inspections, analytical procedures, and team discussions. So anything else, right? So this is the risk assessment process in an organization done by the auditors, right? As far as concerned audit client, right? This is the whole process. Okay. Any comments? Any clarifications? Right? Yes. Now again sound is not clear. Now is it okay or not clear? Yes? Okay, right, thanks. Right, sometimes internet problems are there. So some disconnections, failures. So as a result of that, that won't be clear. So this is what we discussed. Audit procedures performed to obtain an understanding of the entity and its environment, including its internal controls. Right. You can inquire from the management, analytical procedures, observations, inspections. Right. Even internal audit personnel, inquiries of employees, inquiries related to in-house legal counsel, again important. Company lawyers. So what are the legal issues that the company is facing? So you can get the information from them in advance. It's a part of assessing the risk. If they have an issue with that, the license for the operation, right? There may be. So there is an issue with the continuity of the business. If they don't get that, the license to continue the business, then how do we continue the business? If it is the case, you have to disclose that in your audited financial statements, right? So then inquiry towards marketing or sales personnel, you should do those things. And the analytical procedures, yes, as we discussed, you have to identify unusual transactions and events, amounts, ratios and trends, and you have to understand the fluctuations and focus more on that. So really what has happened, right? So it's a part of assessment, risk assessment. So again, observations and inquiries, very important. You can make the the real observations by yourself as the auditors, really what is happening over there, right? And inspections, right? So and assess your risk, assess the client's risk. Observations and inspections order include these aspects. Observations of entity activities and operations, you can go and see the process and everything and understand what's really happening. Inspection of documents, reading reports prepared by the management, visit to the entity premises and plant facilities, tracing transactions through the information system and see what is happening, right? So you can understand the entity and its environment, industry, regulatory and other external factors, nature of the entity, objectives and strategies and the related business risk. So everything is in the annual report, right? So you don't want to look at the annual reports, but as the auditors, you will want request from the management. Measurements and review of the entity's financial performance and internal controls, right? So, and industry conditions, the market and competition including demand, capacity, price competitions, cyclical or seasonal activities, product technology related to the entity's products, energy supply and cost, everything you can look into. Other external factors, accounting principles and industry specific practices, regulatory framework for a regulated industry, let's say for a bank. So you should understand those things. What are the applicable applications of from the central bank, from the Finance Act. Now you see with the the new budget enactments. So leasing facilities has been categorized or restricted to a certain level. So that you all should have that knowledge and make sure that the companies comply with those requirements, right? Nature of the entity, yes, it's a must in the the planning stage to assess the risk. So objectives and strategies of the related business, already we discussed those things. And as we discussed, internal controls. So very, very important from the again companies or the auditor's point of view. So what's the level they are complying with the internal controls, right? So you can look into that. It's a part of the your test of controls process. So you have to identify and assess the risk of material misstatements at the financial statement level and at the assertion level for classes of transactions, account balances and disclosures. So therefore what is important point here is you have to identify and assess material misstatements at the financial statement level, overall financial statement level, and the classes of transactions and account balances and disclosures level. Yes, so all the aspects where you want to identify, do you find any material misstatements? Right, so already we discussed those things. Identify the risk throughout the process, obtain, understand the entity and its environment, relates the identified risk, everything what we discussed. Right, significant risk is there. What you have to do? The only which of the risk identified are in the auditor's judgment is that requires special audit consideration. Now, as I discussed with you, now auditor do the risk assessment and understand that there is a significant risk. Then what is the next course of action of the auditor? Whether the risk is a risk of fraud, whether the risk is a risk of fraud, whether the risk related to recent significant economic accounting requires specific attention. The complexity of transactions. Now when it comes to fair value accounting, So a lot of complexities arise. What, we can't challenge for the fair. So that management can tell that it's a market value at the point where that reporting those transactions, right? So a lot of complexities can arise. So there you have to have more that focus on those areas. So again, that more risk is involved. So we'll discuss the related party standards if the time permits. So what is related party? Who are the related parties for a business? Right? Related parties are the people or that the individuals or the companies that are related to this business. So let's say simple examples I can explain. So these are the the normal scenarios in the practice. 5 companies, those are the same 5 directors are let's say there are 5 private limited companies. For all, right, the same directors have been appointed. Same directors have been appointed. So then all directors are related parties for all 5 companies. Right? It means family owned businesses, the way that those things are happening. Right? So related parties are there. So you have a subsidiary. Right? You have a subsidiary. So then that let's say like this, right? You have major shareholders are in the 2-3 companies together, termed it as related parties. Now they have a significant influence over the company. That's the issue. See, they have a significant influence over the company. Therefore, they can override the company requirements or the company internal controls or any other the requirements. They will do that through the company, right? Right? So then those disclosed to the stakeholders. Those are not disclosed to the auditors, those transactions. Most of the cases we have the current account balances of this company, that company. So all those are intercompanies, interrelated companies, right? So in that case, those transactions are not prohibited, it's all right. But transactions should be disclosed in a real way or the proper way to the stakeholders. Okay, these that directors, these companies have been done the transactions in those ways. You should disclose those informations to in your audited financial statements. That's a must. So that is a more risky area for the auditors again. Right? That's what discussed here. Because those transactions can happen, outside the normal business, course of the business for the entity. Right? The degree of subjectivity in the measurement of financial information related to the risks, especially those involving a wide range of measurement uncertainty. Whether the risk involves significant transactions that are outside the normal course of business of the entity or that appears other to be unusual. So with the related parties, those things can happen. Sometimes those transactions are maybe in the unusual form. It's a lower price than the selling price. The director is purchasing the goods not for the market price where they are selling. It may be the lower price. So that should be okay, but you should disclose that. So that is what is discussed in detail. Right? Again, when it comes to the accounting estimates, the risk also getting higher, right? So again, fair value is a part of the estimation, accounting estimation. So it's going with the market value. So then what happens is market value goes down. So your estimation may be wrong. So again, higher risk is embedded with those account balances. So you have to look in detail and assess your risk in those account balances. Focus in more on those areas. That is what is pointed here. right? So the auditor should finally document all these, the risk assessment tools and risk assessment aspects, everything, right, for the your final overview, your audit working purposes. It's very important. So documentation is a must for whatever the work you're supposed to do, not only in the risk assessment, so all areas, right? So therefore, this is, the overall discussion on that. Finally, what is talking here, so you have to identify more risk areas. So simply it is given that, related parties is a more risk area where you want to focus more. And again, that accounting estimates, so as we discussed the fair value and all that, so you have to have more focus. So it doesn't mean that other areas there is no risk, but there is a risk, higher risk is there. Definitely in those areas you have a more risk. So include in those areas and the other areas, identify, so what are the more risk areas, and focus more on those areas, and make sure that you assess and identify and measure the audit risk, right, and make the risk assessment on the client, and finally you reduce the risk to an acceptably low level by having a proper audit planning, and make sure that you do the audit in according to the, or in compliance with that, the planning, or whatever the audit plan and the audit strategy, what you have, that design at the planning stage, and perform that, and finally come up with the appropriate audit opinion on the financial statements of that particular audit client. So that is the overall discussion on the planning or risk assessment aspect. Any comments? Any comments? Yes? Right, if you don't have any comments, I will take 10 minutes break, so then we'll come back, right, with the analytical procedures. And again, as we discussed, very important tool to assess the risk of the client in the planning stage. So analytical procedures we'll discuss in different ways, we'll discuss later on, but again very important point is that as a the assessing risk, or tool for the assessing risk of the client, so that is using, right. We'll come back with 10 minutes time. So until such time, please go through with that, and make sure that you are having any questions, you can ask or you can type and put into the text, right. So then I will be able to answer for that. Any comments so far? Right, then we'll come back with the 10 minutes time, right. Okay. Can you hear now? Yes? Can you hear? Right, okay. Can you see? Right, okay, okay, thanks, okay. Right, okay, fine. Right. So any comments, any clarifications? I have already uploaded that, whatever the risk assessment PowerPoint presentation. Any comments? Right. So then we'll move on to that. Right. Analytical procedures. So as a very important tool, as we discussed, as a very important tool for the risk assessment, not only for the risk assessment, for the other areas as well. Now you know that, right? Now you know that we have audit testings. Basically, how? Right? We'll create. Okay, I'll be typing here. We have our audit testings in basically two aspects. Yeah, audit testings to collect the audit evidences. As we discussed, one is what? Test of controls. The other important procedure is what? Number one, test of controls. Number two is what? Number two is what? Yes? Substantive procedures. Test of controls and substantive procedures. Right? Test of controls, as we discussed, to focus on what? Please give you a support, right? To check the internal controls of the business. That is basically done in the planning stage, right? The substantive procedures will be coming into play in the performing level. In the performing level, how does it come? Right? In the form of, so again, the substantive procedures are in two ways. Test of details. Test of details. We term it as TODs. The other is as we are discussing analytical procedures. Right? Analytical procedures. Right? We have the test of controls and the substantive procedures to collect the audit evidences. Here different perspectives, different objectives are there. So we perform the test of controls to collect the audit evidences about the internal control system of the business in the planning stage, that is very much important, right? Then two, that is one is test of details, TODs, test of details. So in the real sense of the word, we perform the testings, right, from the beginning to the end of the transaction. Let's say simple example for a sales transaction. From where the sales transaction start? So you get the customer order, right? Let's say that you get the customer request. From that point to the end point, so that will be the dispatch note or else subsequent settlement of the debtor or the settlement of the receipt, right, or getting the money from the customer. Until such time you check of details, right? So from the beginning to the end, from whole transaction you will be checking. That is test of details. So it's a one way, another way of or another procedure you can perform to collect the audit evidences. That is test of details. Then legal procedures, right? So keep in mind substantive analytical procedures as a tool we use in all levels of audit. You know the levels, all three levels of the audit we use the analytical procedures. What are the three levels of the audit? It's the first one is the planning work or the planning level, then the performance and the reporting level, right? So we use the for a different perspective, different requirement to assess the use the analytical procedures, right? And perform again analytical procedures, so that is coming under, you know, the analytical procedure coming under substantive procedures. The reporting level, in this level as well, in that level as well, we do the, so I will discuss one by one. So then as you discuss, we perform the analytical procedures in the planning level to assess the risk, right? Right. Now understand, so what is analytical procedures? What is analytical procedures? Now you are statement analysis or the, you know, yes, financial statement analysis. Your subject is what? Now you are doing that. Is it financial statement analysis? So what's the name of that subject? That knowledge is very much important. Please let me know that what's the name of the subject. Yes? Is it financial statement analysis? Yes, financial analysis, right? So now you have on financial statement analysis. So then, what do you mean by analytical procedures? Is the same, right? So you identify the expected relationships, right? So that's why you have the ratios. You identify the expected relationships. Let's say simple example, GP ratio. So what is the relationship over there? Gross profit divided by sales. So because profit is a function of sales, so you identify relationship. So already you know you have the ratios. By identifying those ratios, calculate those, you will be able to, right, calculate figures, or you will be able to analyze by calculating those ratios and deviations, and you will be able to identify the deviations, right? You will be able to identify the deviations or the fluctuations. So that will be very much important to plan your work, right? Therefore, what analytical procedures, it is given here. I will come back to that point. Analytical procedures means even information through analysis of plausible relationships among both financial and non-financial data. Plausible means expected relationships among both financial and non-financial data. Why do you perform such procedures in the planning level to deviations, inconsistencies? So if you identify the inconsistencies, then only you can focus more on that. What is the result? What is the reason to have that type of inconsistency? Right? As we discussed, then you can focus on those areas and make your justification by yourself collecting the audit evidences. So these are the reasons to have that type of difference. Right? So it's very important. So that's why it is pointed here. Analytical procedures also encompass investigation as is necessary of identified information that differ values by a significant amount. So that's what we discuss, nothing else. Right. So by having that knowledge, again I will come back to the point where we have discussed, right? So analytical we will be able to use in all three levels, that is planning level and the performing level and the reporting level. So how does it come? So analytical, we can perform the analytical procedures, by using the client financial statements, just the statements, and perform the analytical procedures for the client. I mean for that client's financial statements. Then in the planning stage, identify what are the more risk areas, what are the areas you want to focus, right? So it's a part of the planning work. Then the second level, the what? Performing level. In the performing level, again you can perform analytical procedures to collect yes, audit evidences as a substantive procedure. So it's in some cases. I will give some examples. Now you know, if you have expense or rent income, if you have rented out a building, you have a rent income. If you are in a, that rent facility from somebody else, so then you have to have a rent expense. So these are very frequent transactions. So rent expense or the rent income should be monthly rental into 12 months. Yes or no? So it's a very simple analytical procedure where you can perform, and so you can be comfortable with that, right? So another for salaries, you may have thousands of employees in your organization. Now what you can do is you can't check one by one, right? You can identify that even the management is preparing the payroll expenses or payroll in different categories of employees, right? They have the classes or the categorization of employees. Then what you can do is you can get their categorization and get the average salary into number of employees. It should be almost same with the ledger balance, right? Should be. So different categories get the salaries into a number of employees into number of months. So basically month is 12, so get the monthly average into number of employees into 12. It's a simple analytical procedure you can perform in the substantive, in the performing work as a substantive procedure, right? Very important. So this you can understand in the second level, that is the performing level, even you can do substantive procedures, just as a substantive procedure to collect the audit evidences. Third is the reporting level, right? So at the end, again you want to perform the analytical procedures. So but here procedures by collecting information from the client. Here analytical procedures. at the end, near the audit, right? What? Now, in this level, you have work, yes or no? You audit work, yes, right? Now, note the originally prepared financial statements. Now you are using the audited financial statements. Why? Now you, right? So with the agreement of the management. So now audited statements, but in those statements, right? So you will be able to do the analytical procedures again and again. Then still, if you find, you can find the reasons for those deviations. What are the reasons to have that type of deviations in your, the audit client? So this, do you get the enough information? Do you get the enough, justifications and collect the audit evidence to make your still something lacking? So then you have to collect that, fulfill that, and make sure that you are comfortable by yourself before forming your opinion. So therefore, analytical procedures should be, used in all levels of audit and with the different objectives, right? Different objectives, right? And this is again used in all three levels, right? Not smoothly here, right? So we'll see. Right, sometimes internet problems may be there. Okay. So then what I am telling is, in all three levels we should use the analytical procedures with the different objectives. Difficult to understand. So because of the sound matter, yes? Not clear. Now can you hear? Yes? Is it clear now? Now is it clear? Right. I will get the microphone like this. Okay. Right. Right. So as we discussed, this auditing standard SLAS 520, right? Substantive analytical, this standard can deal with the auditor's use of analytical procedures as substantive procedures. It also deals with the auditor's responsibility to perform analytical procedures near the end of the audit that assist the auditor when forming an overall conclusion on the financial statements. So as we discussed, substantive procedures is coming in the performing level. So near, that is coming in the final stage. With the statements you will be able to do that. SLS 315 deals with the use of analytical procedures as risk assessment procedures, right? So SLS 330 includes required the nature procedures in response to the assessed risk. These audit procedures may include substantive analytical procedures. That you should be able to, or you should use the analytical procedures in your audit work, right? So that is what is mentioned here. So in the performing level as the substantive procedure, and near the audit, near the end of the audit, so that is as in the final stage, and then again as a risk assessment tool you should use the analytical procedures. That's what pointed in the standard as well, right? Nothing else. Okay. Right. So the objective of this standard, as we discussed, to obtain relevant and reliable audit evidence when used in substantive analytical procedures, to design and perform analytical procedures near the end of the audit, right? Then again, so we discuss what is analytical procedures, right? So as we discussed 3:30 about the risk assessment, right? So I'm not going to repeat the same. Right. Okay. So that is all talk about the reliability of the data, because it's general. We should have the reliable data to make the comparisons and everything, to calculate the ratios and everything. Right. So and identify the deviations and to make the further investigations. The auditor should shall design, perform analytical procedures near the end of the audit that assist the auditor when forming the overall conclusion as to whether the financial statements are consistent with the auditor's understanding of the entity. So the all we discuss, right? So by and collect the audit evidence as appropriate way and perform in other audit procedures as necessary in the circumstances, right? So you can do that, the comparisons in these ways, comparable informations for prior period, and it's in the last year, this year, very basic, the analysis and very important, and anticipated result of the entity and the other industries. So again discuss here similar industries. So you can make those comparisons with those and identify the fluctuations. Already we discussed everything, right? So as we discussed, all you can identify as a whole the relationships. So what will happen? Simple example I will tell you. So this year bank loans have been increased. So what would be the impact for the interest expense or the financial expenses of the company? Definitely it should be getting higher. If it is not happening, it means that something wrong with that. Likewise, financial implications or financial, the elements, you will be able to identify the relationships. This year have been increased, but as a result of that, sales be increased. We don't know really that is it happening, right? So you see those relationships as a whole. So it's a overall, the auditor. You recruit particular, then salary expense should be increased. See the relationship. Make your justification, right? So that is very much important. And again, that should be compared non-qualitative informations as well. So then again we discuss, substantive procedures. Yes, we want to collect those evidences, right? So then again you have to make sure the availability and the reliability of those informations, right? So as we discussed, these are the areas where you can have the analytical procedures in substantive level, or that whatever the collection levels of data. Right. Already we discussed those things. Right. So that is what we discussed, nothing to, I mean, go through again and again. So the reliability of data is, it's like, very important point. I mean, so you want to do that, whatever the analytical procedures with the reliable data, right? Otherwise our analysis is invalid, right? If you have material deviations, what you have to do? You have to, change your assess risk, or you have to change your material level. So I mean, to cope up with the deviations, you have to change your the original settings in your planning work, and reduce you want to reduce your audit risk to an acceptably low level. So by having different focus as per the results of the analytical procedures, that is what is pointed here, nothing else. So I think you understand what is analytical procedures and what's the application of those analytical procedures in audit work. So, and very simply, you want to get the the required informations, or the reliable informations for your analytical procedures, because it should be come from your company's informations, or from other competitors' informations, or the industry informations. All should be reliable and accurate. So otherwise your final analysis will be wrong. So then your conclusions may be getting wrong in your analytical procedures. In that sense, you should collect reliable audit evidence, so reliable and correct financial informations from the company's side as well as from the outside. That is what is pointed here at the end. So in this standard, again, I just want to summarize. So what do you want to know? So what is analytical procedures? How does it important for the audit work? And for you to do the proper audit analytical procedures, you should have the correct and accurate, or more reliable and relevant financial informations, and that should be linked with the financial and non-financial informations as well. So not this is only going with the figures, but also with the qualitative informations as well, right? That's what you should know under the analytical procedures, that is SLA US 520. Right? Any comments? Yes? Now can you hear? Is it clear? Now you have any issues? So with that, our discussion. So far no issues come from our discussion. Are you clear? Perfect? 100%? You don't find any questions? Do we have any questions? No? Everything is clear? Apart from the technical matters? Yes? Any clarifications? And here now? Any clarifications? No? Right. Any issues? So do you get the things? Is it valid, or is it important to you? Or I don't get any comments. Right. So I am talking. Nobody is here. It's all right. But your interaction, I mean, your comments are very much welcome. Yes? Right? No issues? You understand? Right? Right. If you don't find any issues, so I just find that I am not going to discuss this. This is your one of the subject, not a topic even. So I just upload this, and that financial statements analysis. So basically, in analytical procedures, what is required is this one, right? What is more for, yes, so this is what is required for me, I mean, as far as concerned analytical procedures. So basic analysis and some of the advanced analysis methods. So basically horizontal analysis, trend analysis, vertical analysis, those are basic methods, and advanced methods again coming with the ratio analysis. Basically you should do the horizontal analysis, trend analysis, vertical analysis, and the ratio analysis. And your analysis tools for the analytical procedures. Already you did everything. So right, so that should be coupled with the qualitative information as well to have the proper analytical procedures, right, and identify what are the risk areas and all that. So just to tell you, you can have ratio analysis in basically under 5 categories, the profitability and long-term solvency, short-term solvency, liquidity, and the performance and the profitability. So under those categories, so based on the information given, you will be able to calculate. So then what is today's exercise is, so all that information are available here, and even you have the knowledge, right? Please look into this example. Please look into this example and do the analysis, and so coupled with this, the qualitative informations. So please ratio analysis and identify what are the more risk areas where you want to look in detail, right? So that is your question. Perform analytical review procedures for Bloomer PLC as a risk assessment process and identify what are the more risk areas, right? So I will give 15 minutes. Please do that horizontal analysis, vertical analysis, and ratio analysis, right, and identify what are the risk areas of that particular company. Actually this will be the first question in your paper as well. So far we have discussed that planning work, analytical procedures, and identify the risk areas, and how do we reduce your risk to a acceptably low level. So that is your first question in your paper as well. You see that past papers, that is your first question. The same way, so that will be addressed in your that as the first question in your paper. Therefore this knowledge is very much important, right? So that will take basically 30 marks. Everything will be covered until today's discussion, right? So therefore you should be familiar with these areas. In that sense, really work on this and identify what are the more risk by performing the analytical procedures. I'll give 10 to 15 minutes and we'll discuss what are the more risk areas, right? Please look into that and work on this. By the way, if you have any comments, you can ask. Okay, right, so please work on this. So that is uploaded to the LMS, right? You can download from that as well, right? Please work on this. By the way, if you have any comments, any clarifications, you can ask, right? Okay, work on this. If you have any comments, you can ask, right? So you horizontal analysis, you can do the vertical analysis, and some of the issues you can and right. So and you want to, I mean, for the results or risk areas what that you have identified. Hope that you all are working on this example, right? Any clarifications, any comments you can ask. Right. So what are your comments? So I did the basic analysis. What are your comments? Yes, yes. Can you hear? Right? What are your comments? Okay, I will come back with this. You know, you can do the horizontal analysis. So this is how you do that horizontal analysis, right? You know that. Okay. Right. So you see, sales has increased from last year to this year by 14%. Cost of sales, what has happened? This is something wrong because last year figures is not there. So I just delete that. What has happened? 14% revenue has, or the sales has been increased. Cost of sales has been increased by 19%. Right? So then gross profit, what has happened? 6% increase. Sorry, 6% reduction. This is right, sorry, this is something, I mean, this is vertical analysis. Okay, so you see only this. Gross profit reduced by 6%. Now you see, sales increased by 14%. As a result, gross profit reduced by 6%. Now, can this happen? Sales increased by 14%. Gross profit reduced by 6%. Can it happen? Yes or no? Do you get this analysis? Yes or no? Can you hear? Right. So you get the point what I am telling? Sales increase, but gross profit reduce. Can it happen? In this case, because normally we increase the sales to what? To have more profits. But in this particular case, you know, gross profit has reduced because the cost of sales has been increased. So this is something unacceptable, but that has happened because of that increase in the cost of sales by 19%. Right? There, you want to look into this. Really the sales has been increased or cost of sales has been increased. So you want to look into that. You have to focus on that area when you are performing the audit work. Right? That's the objective of this analysis. You see here, gross profit ratio has been reduced from 21% to 17%. Can it happen? Under the circumstance of sales has been increased. So top line is increased but bottom line is reduced. Can it happen? So net profit has reduced by 3% to 1%. Again, can it happen? Right? So debt equity ratio, again when it comes to debt equity ratio from 69% that has been reduced to 56%. Current ratio, again it's good condition, 2.7 to 2.5. Is it excessive money the management is keeping with the business? So it's up to the management to decide. But from the auditor's point of view, it's all right. Right? So then again you can do the vertical analysis from the total sales, so how much the expenses and all that. So likewise you can do the financial statement analysis or the analytical procedures and identify the risk areas so in your planning stage. Again it is given some of the informations here. The industry that Bloomer Trade has been a moderate growth of 7% over the last 7 years. 7% growth is there in the industry. Yes. So in this particular company, 4% sales increase is there. Is it outstanding compared to have that much of increase compared to the industry? You have to think about that as well. So not only thinking, but you have to collect and make the justifications by yourself. So that much of sales increase is really there. Inventory is stored in 10 different locations across the country. Some inventories are held by third parties. Again, it's a risk, right? So different locations, there is a probability of having misuse of those inventories as well as those are with the third parties as well. Look into that as well, right? So those are the risk areas you have to focus. Again, in view of the corporate goals for 2015, in particular budget says the company has given extended credit period to selected customers. Then what will happen again? So customers default will get in higher because of the extension of the credit period. So you have to look into that as well, right? A new incentive schemes including share ownership schemes has been introduced during the year under which remuneration of directors are linked to the achievement of targets. Again, as I pointed out, it's going with the target, it's all right. But again, there is a pressure, there is a probability of manipulating those financial statements to get the, specified benefits. There may be a pressure. It doesn't mean that always these things are happen, but there is a pressure to happen, that there is a probability to happen that type of situation. Again, it's going to the computerized system for the inventory, new system. You have to look into that as well. So to what extent those systems are, correct, accurate, applicable for our work. So again, there is a risk on that. Past experience of the company indicates sound internal control system. Yes, it's the idea. So the company is having the good internal control system with the past, but again you have to compare those with the present situation. Is it really good internal control system and it's compliant the business in this particular current year for the, that is the year you are making the audit. So you have to make sure those aspects. So this is the basic analysis in the risk assessment, right? So you have to have comprehensive analysis in the planning stage and identify the risk areas. So that's how this will be useful. As the analytical procedures, this will be useful in the planning stage to assess the risk of the client, right? This is a very simple the application, the exercise to discuss, to familiarize with the analytical procedures in the planning stage for the auditor's point of view, from the auditor's point of view, right? Any comments, any clarifications? Your active participation is that much, not that much expected level or the higher level, right? So I don't know where it is wrong. So yes, any comments before winding up our session? Yes means you understand, have you done your analysis? You find a lot of the deviations, a lot of inconsistencies, risk areas, right? Please work on this and get it familiar with these applications, and even the past papers have been uploaded to the LMS. Look into those and be familiar with those, and make your questions, answers, clarifications and everything to the lecture, and we'll discuss, right? So that's how effective learning process will work for you to get the maximum out of the subject, right? If you have any comments, are you okay, comfortable, right? Yes, right. If you don't have any questions and clarifications, we'll wind up the session from this point, and we'll meet on next week with the rest of the auditing standards, right? Now actually the planning level work has been completed in our audit work, so then we can move on to the the performing level of our audit. So then those standards can be discussed next couple of weeks. So right, and by the way, you want to ready for your assignments and the presentations. So I already given all those informations. Please work on that, and we can have the presentations. So by 13th for the 14th week, right? So 1 week before the final session. So and finalize those work, right? So during this time, so make comfortable, make your presentations for you. Make ready for your presentations and the assignment work. So during this time, Okay, thanks. We'll see you on next week.